Time now for an investing session with Steve Ruxton. Here's more.
It's Investing 101, a number of big economic and financial stories in 2018, and it looks like a number of those stories are going to be with us into the new year. Let's bring in Mark Eady. He's a principal with Naperville Financial. Mark, good to see you.
You too. Thanks for having me.
Got to talk about one of the biggies, the ailing, stumbling bull market. Some are saying it's not even a bull market anymore. What's your equity outlook for the new year?
Well, you're right, Steve. In this August of 2018, we marked the longest bull run in history, nearly 3,500 days. But since then, we've lost all the gains for 2018.
Right.
Even though we can't predict what Wall Street's going to do next, we can always have a diversified plan that makes sure it's staying on pace for our goals, is appropriate for our age, and where we want our income to be when we retire.
This dovetails really well into one of the other big stories in 2018, which had to do with interest rates and the Fed. And of course, that was a big weight on equities. The Fed raising rates. We saw equities drop. What about the new year? It does seem like the Fed is becoming a little bit more dovish about rates in the new year.
Yes. Raising the rates is one of the causes for the volatility we've seen on Wall Street. When the Fed raises the rates, even though it's not directly linked to the rates that are tied to our debt, they often go hand in hand. This results in us having to pay higher interest rates on our debt. Even though other accounts like our CDs and savings accounts, those interest rates are also increasing, they don't increase as quickly. So there's a little bit of a catch-up process that has to occur.
We know that President Trump has been pressuring the Fed not to raise rates. Are they going to listen in the new year, or are they going to continue to be independent?
You know, it's tough to say at this point. If the rates continue to go up, that volatility will continue. And this is like the cost of borrowing is going to go up.
Absolutely.
And so some firms
already is.
Yeah. Some firms are absorbing those costs while others are passing along to the consumer. So this isn't a problem that's going to go away anytime soon.
Okay, another biggie. Trade war, tariff talk, President Trump saying that he's a tariff man, extreme volatility in 2018. We were talking before we went on the air about how a story can pop the market one day, another story can drop it back down. This story doesn't look like it's going away for a while.
Right. With the different tariff talk that's out there, it's again increasing the cost to import goods from China. Firms are passing those costs along, sometimes absorbing them, but at the end of the day, it causes waves in the market, and Wall Street doesn't like that.
At the G20, President Trump, the leader of China, came up with a 90-day window to get a deal done. Are they going to do it, do you think?
Tough to say at this point. There's so much banter back and forth. We're just really not that sure yet.
Final one we got to touch on, the tax cuts, the tax bill that President Trump and some of his folks pushed through in 2018. How is that going to affect investors and just everyday people in the new year?
Sure. The new tax brackets have put 80% of households in a lower tax bracket than last year, nearly $100 billion in tax savings. A lot of the employers out there actually have been holding back less on our paychecks.
Surprise!
Taking more, so we're taking more home. But people haven't checked their deductions. A recent survey said that nearly 70% of the people out there haven't checked their deductions over the last 6 months. So it's a good idea to take a look and see, because the holdings tables have also changed. So it's good to make sure that you're on point with that.
Okay, a lot to be aware of. I wish we had more time. Thank you, Mark.
My pleasure.
Appreciate you coming.
Thank you.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.